This session covers performance management for both the private sector and the not-for-profit and public sector. Firstly, let's understand what performance measurement actually is. Performance measurement aims to establish how well a company or individual is doing in relation to a given plan, and it is a vital part of the planning and control process. At a high level, performance measures can be divided into two types: financial performance indicators and non-financial performance indicators. Financial measures will typically relate to figures from the financial statements, e.g. revenue, profits, return on capital, cash flows, etc. The actual performance is usually measured against a financial plan, such as a budget, or performance could be measured by comparing the most recent set of data against a previous time period, or maybe even comparison against a similar business or an industry average. Non-financial measures can relate to whatever is important or critical for an organisation. This will vary from one organisation to another, but could include measures around the quality of the goods or service provided, customer feedback, achieving deadlines, or maybe capacity utilisation for a manufacturing company. Whilst financial indicators tend to be historic in nature, e.g. backwards looking for a time period that has already elapsed, non-financial indicators are often a good indicator of the future financial performance. Strong financial performance is not achievable in the long term unless non-financial performance is strong to sustain the business moving forward. Whether performance measures are financial or non-financial, there are several factors that organisations should consider. Any form of performance management will require some form of resource to collect and analyse the information. This could be staff time or maybe equipment. Either way, the costs and benefits of providing the resource should be carefully weighed up. All measures must be measured in relation to something. Overall, this will be the company's objectives and the plans that will cascade from those objectives. It is important for a business to identify the factors that are important or business critical to the success of achieving those objectives. In addition, the measures should be fair. If managers are targeted or incentivised for achieving certain targets, the measures should only include areas that the manager is responsible for and has direct control over. Ideally, a variety of measures should be used, and the balanced scorecard is a good example, as it ensures that performance measures are formulated from a number of different company perspectives. In addition, a mixture of both long-term and short-term achievements should be measured. While short-term targets are very valuable to an organisation, too much emphasis can lead to a short-termism effect, where decisions are taken for the here and now with little regard to the long-term future of a company. An example of this would be postponing expenditure on machinery to achieve a current budget, with little consideration to the longer-term impact of not having reliable machinery in the future, whilst a long-term measure may link a manager's bonus to the company share price. Once suitable performance measures have been identified, they should be monitored on a regular basis to ensure that they are relevant and they are providing meaningful information. Performance measures can be both quantitative and qualitative. Quantitative measures are expressed in numbers and by measurements. This will include all the financial performance measures and measures that are numerical, e.g. number of units or number of hours or maybe cost per unit. Qualitative measures are not numerical. These measures may relate to quality of product or service, maybe customer loyalty or possibly employee morale. By the very nature of these types of measures, they are subjective and judgmental. For example, one customer may rate a service as high, whereas another customer may consider the very same service as just adequate. That said, qualitative measures can still be very valuable to a business. Now we will return to the financial performance measures and look at some specific examples for the private sector. For ease, these measures can be grouped into 3 categories: profitability, liquidity and gearing. The first category we will look at is profitability. There are obvious checks for a company regarding profitability. For example, is the company profitable? And if so, by how much is the profit greater or smaller than last year? In addition to that, there are other ratios that an organisation can calculate. The first one we will look at is called the gross profit margin. The calculation for this is the gross profit divided by the revenue. The ratio is usually expressed as a percentage, and from the company's perspective, the higher the better. To improve this measure, a company will need to either increase its revenue or decrease the cost of sales. The measure can be used for comparisons against previous periods within the same company, comparisons against similar size companies within the same industry, or maybe against an industry average. The gross profit margin is rarely used in comparing companies in different industries, as dependent on the nature of the business, they could have very different cost structures. The next ratio is called the net profit margin. For the purpose of the ACCA F5 exam, the net profit margin is calculated by either profit before interest and tax divided by revenue or operating profit divided by revenue, dependent on what you are given in the question. As with the gross profit margin, the ratio is usually expressed as a percentage, and again, from the company's perspective, the higher the better. This ratio considers all the costs to the company, including administrative and distribution costs. Again, it is only meaningful when compared to previous periods within the same company or performance of similar sized companies within the same industry. The next ratio is called the return on capital employed. It isn't possible to accurately assess profit growth within a business without relating profit to the amount of funds that have been invested in the business to help generate those profits. The investment is termed as capital. The return on capital employed, often abbreviated to ROCE, is therefore an important profitability ratio as it links these two elements together. The calculation for ROCE is profit before interest and tax divided by the capital employed. The capital employed is the shareholder funds plus any non-current liabilities. The capital employed calculation is the equivalent of the total assets less the current liabilities. ROCE is expressed as a percentage, and from the company's perspective, the higher the better. In terms of comparisons, well, they can be made from one year to the next within the same company, maybe against the ROCE being earned by other companies of a similar size, or comparison can be made with the current market borrowing rates. By comparing to current borrowing rates, a company can decide whether its ROCE suggests the company is making a sufficient return to make any future borrowings worthwhile. The next ratio we will look at is called asset turnover. Asset turnover is a measure of how well a business is using its assets to generate sales and is calculated by revenue divided by capital employed. This measure is normally just expressed as a number. For example, if two companies had equal values of capital employed, but one company had double the sales revenue of the other company, this company is said to have a higher turnover. This is due to the fact that it is able to generate double the revenue from the same value of assets. Together, net profit margin and asset turnover explain the ROCE calculation. The relationship between the three ratios can be seen as follows: net profit margin multiplied by asset turnover will equal ROCE. The last measure in the profitability category is earnings per share, or quite often abbreviated to EPS. EPS is a measure that relates profitability to the shareholder. It is calculated as profit after tax and preference dividends divided by the weighted average number of ordinary shares in issue for the period. Essentially, it looks at what is potentially available for the ordinary shareholder after deducting all liabilities and converts that to a profit value per share. The EPS is a widely used measure of a company's performance, as a company must be able to generate sufficient earnings in order to firstly pay a dividend to the shareholder and then reinvest any surplus back into the business to support ongoing future growth. From an investor point of view, the EPS measure is also important. An investor will be looking for growth in an EPS from one year to the next. The next category of ratios to look at are concerned with liquidity and cash flow. A company may be financially profitable but will struggle if it does not have sufficient liquidity, i.e., cash to pay its debts when they fall due. Before looking at the key ratio calculations, it is important to understand what is a liquid asset. Liquid assets will include cash, trade receivables, deposits with the bank, and any short-term investments which can be readily converted into cash, e.g. shares. Inventory is generally deemed not to be liquid, although it would depend on the speed of the inventory turnover. With a wholesale and retail business, e.g. a supermarket, inventory may well have a fast turnover and cash may be realised very quickly. But with a manufacturing company, say with a lengthy production cycle, the working capital cycle, i.e. the time that will elapse from paying for the raw materials to receiving the cash back into the company from a customer, can be considerable. The first ratio calculation to look at is the current ratio and is the standard test of liquidity. This is calculated as current assets divided by current liabilities and is expressed as a ratio. The thought with this ratio is that there should be enough cash or promise of cash to come in order for a company to pay its current liabilities. As such, a figure greater than 1 would be expected. However, this ratio will vary quite significantly between different types of businesses. The next ratio to look at is the quick ratio, also known as the acid test. This ratio is calculated as current assets less inventory divided by current liabilities. As already mentioned, in most cases inventory is not deemed to be a liquid asset due to the speed of conversion to cash. Ideally, this ratio should still be greater than 1 for companies with a slow inventory turnover. For companies that have a rapid inventory turnover, a quick ratio may be less than 1 without suggesting that the company is having any cash flow difficulties. It is also important to note that a company may have a current and quick ratio that is too large. This would suggest overinvestment in inventory and maybe large volumes of trade receivables and cash, hence tying up more capital in the business than is actually required. This would suggest poor capital management. Up next is the receivables payment period. This is calculated as the trade receivables divided by the credit revenue. The measure is usually expressed in days, so the equation needs to be multiplied by 365. This measure allows a company to calculate the average length of time it takes for customers to pay them. Close monitoring of this is essential for companies to avoid a high receivables figure and hence running into cash flow difficulties. The next measure is the payables payment period. This is calculated as the trade payables divided by either credit purchases or the cost of sales, dependent on what is provided in the question. Again, this measure is expressed in days, so the equation needs multiplying by 365. This measure allows a company to calculate the average length of time it takes to pay its suppliers. From a cash flow perspective, companies will normally take full advantage of any credit period offered. However, it is important for companies not to abuse the agreed terms, as this could lead to loss of goodwill and ultimately restriction on supply. The next measure is the inventory days or inventory turnover period. Inventory days is calculated by inventory divided by the cost of sales and again multiplied by 365. This measure indicates the average period that a company holds its inventory. An increasing inventory days calculation suggests slow-moving inventory, which can then lead to build-up or excessive holdings. In addition to potential cash flow problems, too much inventory can also lead to loss through obsolescence or damage, and there may be associated related costs such as warehousing and insurance. On the other side of the coin, it is important that companies hold sufficient inventory to avoid loss of sales through stockouts. This measure can also be expressed as the inventory turnover period, where the previous calculation is just reversed. Before moving on to the third category of ratios, it is important to realise that caution is needed when calculating liquidity ratios, as the statement of financial position may not be representative of the norm at the financial year end. E.g., if a company made a large one-off credit sale just before the financial year end, the trade receivables would be abnormally high. Or maybe a company has a large inventory delivery just before the financial year end, resulting in abnormally high inventory holdings. Where there is sufficient detail in a question, average figures from the statement of financial position should be used, e.g., add the opening balance to the closing balance and divide by 2. The third category of ratios are concerned with gearing. All assets of a business must be financed through one means or another. As a company starts to expand, additional finance will usually be needed to acquire additional assets. There are different ways that a company can be financed, and this is known as the capital structure of a business. At a high level, there are 2 options open to a business for long-term finance. They can raise capital from shareholders, known as equity, or they can borrow funds, known as debt. The gearing ratio looks at the relationship between the shareholder funds, i.e. equity, and the debt. Typically, there are 2 accepted calculations of this ratio, either debt divided by debt and equity, or debt divided by equity. The measure is expressed as a percentage, and generally any ratio greater than 50% would denote that a company is highly geared. So what exactly does this ratio mean, and why is it so important? Shareholders will be expecting a return for their investment, and this is called a dividend. However, should a company have low profits or be loss-making, any dividend paid to ordinary shareholders is purely at the discretion of the directors of the company. In addition, the company has no obligation to purchase any ordinary shares back from the shareholders. In contrast, if a company has borrowings, it will still have an obligation to pay interest and at some point redeem the borrowings. If a company has sustained losses, ultimately it will reach a point where it is unable to meet its interest commitments. As such, the higher percentage of capital financed through debt, the higher the financial risk associated with the company. It is important for companies to keep their debt under control, otherwise banks or other lenders will likely refuse further borrowings at some point in the future. Gearing measures the percentage of long-term finance that is debt. The greater the percentage, the more highly geared a company is, and the greater the financial risk associated with it. So far, we have looked at specific financial performance indicators. Now let's take a look at some typical non-financial performance indicators. Non-financial performance indicators are generally a useful guide to future financial performance. Unlike financial indicators, they will vary significantly between different types of businesses, dependent on what is important or business critical to the organisation. Usually within an exam question, there will be some judgment needed as to identifying the most suitable non-financial performance indicators dependent on the nature of the business. As a general guide, non-financial performance measures could include quality of goods or service. This could be formulated by the number of rejects within the production process, or maybe the number of customer returns or warranty claims. Delivery. This could be calculated by the average time between taking and delivering an order. Reliability. Well, this could be expressed as the percentage of equipment failures or maybe downtime. Innovation. This could be calculated as the number of new products launched over a given time period, or maybe the value invested in development of new products. Customer satisfaction measures may include the number of repeat orders, number of new accounts opened, or maybe the percentage of on-time deliveries, or maybe the number of customer complaints as a percentage of total sales volume. Employee morale could be measured by surveys. As non-financial performance indicators can measure and compare just about anything, it is important that companies do not suffer with information overload. The measures need to be meaningful and they need to be tailored to the business. As mentioned earlier, it is important for companies to have a mix of both financial and non-financial performance indicators. This will stop too much concentration on too few variables, whilst ignoring other important variables that maybe cannot be expressed in monetary terms. Once all suitable performance measures have been identified, it is important to monitor them, analyse the performance and identify reasons for unexpected performance. To identify possible reasons, you may need to apply some judgment to the facts given in an exam question. For example, an increase in product quality issue could be down to using cheaper materials or maybe using inexperienced staff. Customer dissatisfaction with an online service could be due to a poor website design or too much downtime, or an increase in machine unreliability could be due to reduced or inferior maintenance. Any possible improvements in performance should be linked to the possible reasons for the poor performance, e.g., hire more experienced staff or provide additional training, redesign of a website using a specialist company if necessary, or maybe increase the scheduled maintenance of the machinery. The last part of this session will focus on not-for-profit organisations and the public sector. Not-for-profit organisations and the public sector are likely to have significantly different goals in comparison to a private sector business, as profit is not their primary goal, and generally they do not have to be successful against the competition. If the organisation has no sales, measures such as gross profit margin or ROCE could not be calculated or are meaningless to the organisation. Nonetheless, these types of organisations will have objectives, although they can be more difficult to define, and in addition it can be difficult to say which objective should override another. For example, a charity may well have financial measures concerning charitable income donation and reducing overheads, but it will also have measures concerned with providing a service for local people, maybe the elderly, or perhaps protecting the environment. A hospital will have financial measures concerning costs and budget achievement, but will also have measures concerning, say, reducing waiting times for patients and providing good quality health care for all. To complicate matters further, it can be very difficult to judge whether non-quantifiable objectives for these organisations have been met. For example, has the standard of healthcare in a hospital improved or not? Or has a charity improved the situation for the local elderly community? Typically, statistics around size of budgets, number of employees or volunteers, or maybe number of customers serviced and facilities provided are useful to evaluate these objectives. Normally, performance will be judged in terms of inputs and outputs, which ties in with the value for money criteria of economy, efficiency, and effectiveness. So let's look at each one of those in turn. Firstly, economy. Economy will focus on the inputs for an organisation and obtaining them at the lowest acceptable cost possible for the level of service to be provided. Economy does not necessarily mean straightforward cost cutting, as resource needs to be of a suitable quality. Cost cutting that leads to service standard falling below an acceptable quality level would be false economy. For example, for a hospital, this would be the cost of the doctors and the nursing staff, the medical equipment and the facilities needed. If the cost cutting is too severe, the hospital will be unable to provide the required level of health care. The next one is efficiency. Efficiency is all about getting the greatest output possible from the level of inputs, i.e. no waste. So again, for a hospital, that would mean ensuring that doctors and nurses are fully utilised, theatres and expensive equipment are fully operational and running to the maximum, and drugs are not wasted. Lastly, effectiveness. Effectiveness is concerned with achieving the end result or objective, e.g. getting the job done. For a hospital, this would be measured as providing the appropriate level of healthcare for the patient to cure the ailment. There is always a trade-off between economy and effectiveness. Organisations will usually have the ability to resource their inputs at a lower cost. However, if the cost cutting is too severe, then the organisation will struggle to achieve its end objectives. Public sector organisations are now under considerable pressure more than ever to operate economically, efficiently and to be effective, and are normally required to draw up some form of action plan to demonstrate how they will achieve value for money. Typically, management may be subjected to value for money audits to ensure services are being delivered in the most economical, efficient and effective way. The audits can be conducted by an internal audit department or may be carried out by an outside specialist organisation.